Hello, everyone. Thanks for joining us here for the first of 4 online sessions today. This is OIC's October Online Summit. Very excited about the material that we have, a mixture of options education and some industry personnel insight. We've got a lot for you, and this is session number 1. My name is Ed Modler, the Director of Retail Education at the Options Industry Council. We're going to be focused today in this first session on options basics, getting that foundation set. I'm very pleased to welcome Marty Kearney, an options instructor at MIAX, who will be doing most of the work today. Marty, before we get through the initial presentation outline and some opening remarks, can you give the audience just a quick introduction of yourself and your background in the industry?
I sure will, Ed, and thank you, and thank everybody at OIC for allowing me, representing MIAX, to come on and talk. I was an individual investor starting out without too much option knowledge years ago, as some of the people that will be listening in. I then was a floor trader. I went down and was a market maker and a floor trader at one of the exchanges in Chicago for 12 years full-time and 4 years part-time. I helped start a little securities firm to handle retail investors. And then I was on the staff of the Options Institute, the educational arm of one of the larger exchanges, to help individual investors and even some brokers learn the nuances of options and how to use them in a very conservative manner. So I'm semi-retired. I consult for people like the MIAX, and I am happy to be here to lend a little knowledge, and maybe we can answer your questions. Ed and I can put our heads together, and we can help get you pointed in the right direction. And he also has a good team working in the background, by the way, too, that will help from Investor Services at OIC that will handle your questions. So I'm going to turn it back to you, Ed, and I'm looking forward to today's presentation.
And thanks again for joining us here today. You certainly have a lot more than a little knowledge, so I know we're going to get to a lot of good stuff today. Here is the OIC disclaimer, and about OIC. Founded in 1992 as an industry cooperative, OIC initially intended on just strictly providing unbiased free education to the public to dispel some myths and to help investors understand the product much better so they can use it more wisely and effectively. Still going strong here about 27 years later. You can find us at optionseducation.org. That's where most of our educational material is housed. You can find different formats, written material, podcast, videos. We're also doing webinars every month, part of this series, the OIC webinar series. Check the events calendar, see what events are coming up, and please register for our online webinars. Marty already mentioned the good guys at the Investor Services desk. Mark Benzaquin is heading that team with Ken Keating and Bill Ryan. They are behind the scenes answering your questions. All of your questions and comments will get answered. We'll try to do that live behind the scenes with the Investor Services team. If we have time, me and Marty will pick apart your questions as well. Anything that doesn't get answered will get responded to by email by the Investor Services team in the near future, so keep your eyes open for your email as well. I want to take a look at the industry, just a snapshot of volume. You can see the huge growth in volume as we turned the century. A number of things happened there, multiple listings, and of course, electronic trading. That was also on the tail end of the beginning of do-it-yourself investing and investors taking control of their own money. The expansion was massive, and you saw the spike there in 2011. For those of you in the markets during 2011, you may remember the European sovereign debt crisis, which caused elevated volatility throughout that year. And that was an outlier year for a little while until 2018, when we set a record going over 5 billion contracts cleared. 2019 is not looking to be that strong, but we're still looking at right now about 19.5 million contracts on average being cleared every day. So the industry is thriving. Everybody is certainly using options in a much more extensive way than ever before. We'd like to think we're a part of that, and things are going to be looking good into the future. Here's where all the action takes place at the exchange level. This is where your orders go. When you send them through your platform, they get executed at the exchange level. Also, investors may not realize these exchanges are deciding which stocks will get options contracts, because of course not all stocks do, and then when that decision is made to go ahead and list options, a further decision is made, what expiration months are listed, and there's a general guideline for how the exchanges make that decision, also what strike prices to list. And as you trade options, flipping from one symbol to the next, you'll notice that they could look a little different depending on what the symbol is. The exchanges will look at what the investor wants, and they will try to give the investor everything they possibly can. They don't take the decision lightly, of course. More options, more strike prices and expirations also means more of a demand from a technology perspective and from the market-making community that's there to provide the liquidity. But the exchanges do try to list everything and anything that they possibly can. As I said in the beginning, this session here aims to set the foundation for basic options knowledge and make sure you understand key terms. So we'll start with defining puts and calls, and then walk through some concepts you really need to know. Exercise and assignment, of course, is paramount. And then also maybe take things a little bit further, talking about the pricing of options. Moneyness is a term that comes up quite frequently. We'll look at what that is and talk about its relevance and why it's important. Theta, whether you're an option buyer or seller, is certainly important. And then popular strategies. These certainly aren't strategies that are recommended for anyone as they get started, but more of the common strategies for those of you newer to options, or even if you've used options a bit. Marty will break some of those strategies down. And as I turn to you, Marty, to start to walk through, one of the keys to using options in portfolios usually is there's a multitude of motivations for why investors start to use them. And as you break down what an option is, I know you're going to do that as we walk through this initial segment, what options are and key things to know. Maybe we just start with a look at what those objectives are and how options begin to achieve those objectives.
That's a great idea, Ed, and I'm going to do that right now. So let's talk about why do investors choose options? Why would you get involved with options? You probably understand at least the basics of buying and selling stock, but options is kind of a different animal, isn't it? So some people use options to reduce risk. I have a position on, I own some stock. We're coming into earnings season, or we're coming into a Fed announcement or an election or something that may concern me. Well, if you don't have options, the only other option is to sell your stock, right? You're either in the stock or you're out of the stock. But with listed options, what you can do is we can reduce risk. We'll give an example of that coming up in about 20-25 minutes or so. So you can also generate income. Now, this is one of the strategies I first started with years and years ago when I had a real job at one point in time. I worked for a company. I was buying shares of the company's stock, and I decided, maybe there is a way to use options to generate a little bit of income, where I would sell an option against the stock I own. I'll explain that to you in a second, and I will generate income. So that was the second way that people use options. The third way is it says stock acquisition, but maybe it's not always acquisition. I'm looking at stocks right now, and there seem to be a lot of very expensive stocks at $100 a share or $400 or $800 a share. I don't have that much money to buy 100 shares or 500 or goodness knows 1,000 shares, right? So some people use options as a surrogate, right, to control the underlying shares. And if I decide to buy a certain type of option, we'll explain that in a second, on a particular stock I'm looking at, or a basket of stocks, maybe an ETF, I have the right, we're going to see that in a second, to control that underlying stock. And if I decide to acquire the stock does very well, I think I'd like to add this to my portfolio, and I have the financial means to do so, I will do something that I'll explain. I'll exercise that option, or I can sell the option. Okay? So when we're looking at options, right, what are options? Well, you know what? Options are contracts. If I buy an option, I have a contractual right to do something. And I have the right to buy, if it's a call option, or the right to sell, if I'm buying a put option, the underlying shares. Okay? And the nice thing about listed options, Ed had that picture up of the different exchanges. The nice thing about listed options is that it's a specific stock. It's a specific number of shares, usually 100 shares, unless there's been an unusual split or some sort of a corporate action, right? It's on a specific date. Usually it's a Friday in the future, right? And I have the right to buy that particular stock or ETF when I'm buying an option. The nice thing is when Ed showed that picture of the exchanges, that your broker is just looking to get you the best available price. There could be a good price on one exchange to buy the option, and there could be a more favorable price for you to sell the option if you're trying to buy one on a different exchange. You don't care where this contract trades for the most part because your broker is trying to get you the best price. You'll have to talk to your broker, okay, about that. But when you decide to sell that option, if that's what you'd like to do, your broker just sends it to whatever exchange has the best price for you to sell that option. So you don't have to worry about, I bought it on MyX, I have to sell it there as well. No. This is a standardized contract that you can buy or sell on any exchange, and your broker will handle all of the paperwork and all of the direction on this, okay? So a buyer of a call, right, has the right but not the obligation to buy at the strike price. It's your right to do something, okay? A buyer of a put has the right, once again, but not the obligation to sell the underlying shares, all right? So here's what you have. If I buy an option, whether it's a call option, which is the right to buy the shares, or a put option, which is the right to sell the shares, I have the right to do something. I can sell this option at any point in time. Okay, I bought a December option this morning, and 5 days later I decide I no longer wish to hold this particular option. I can go back in and sell that option. Okay, I could also exercise the option. So when exercising the option, I let my broker know that I own 5 contracts on XYZ, the stock. I would like to exercise my option, and if it's a call option, I would like to take delivery of 100 shares times 5 contracts, okay, and I would like to take delivery of 100 shares of stock. If it's a put, I have the right to deliver the underlying shares of stock, all right? So I have the right to do something. For this right, I'm paying money, okay? And when we're looking at it, remember I said that each contract usually represents 100 shares of the underlying stock. So when you go to your broker's website and you see a particular option you're looking at is trading at $3, it is trading at $3. That's per share. The option contract is worth 100 shares of the underlying stock. So if you were to buy that option, you would pay $300. Okay? So now what do you have? You have the right, okay, to buy the underlying shares at that particular price, the strike price we talked about, okay, anytime between now and expiration Friday. What's the most you can lose? It says here that represents the amount at risk. If you buy a stock, let's just say the stock is trading at $60, all right, and you buy the 60 strike price call for December. You have the right to buy 100 shares at any point in time you choose at $60 per share. Well, let's just say that stock goes to $40 per share. It has some terrible news, okay? Fill in your own blank on what the news would be, all right? Well, if you own the underlying stock at $60 per share, if you owned 100 shares, you'd be down $2,000, wouldn't you, with the stock trading at $40. If you own the 60 strike price call and you paid $3 in our example, okay, it would not be worth very much money, would it? But it's still an option. You can only lose what you paid for it. In this case, $3 or $300 to control 100 shares of stock. So you do have risk. When you buy an option, you have risk. But the option is limited to the premium or the dollar amount you pay for that particular option. So let's take a look at an example, okay, of what else happens when we've got this particular option. In this case, we're looking at XYZ. It's trading at $79 per share. It's kind of expensive, right? If I buy 100 shares, that's $7,900 that I'd have to pay. But instead, I'm going to go out and buy a December 20th. Now, that looks to me to be the third Friday in December. Okay, I'm going to buy the December 80 strike price call option. Okay, and I'm paying $1.50, so I'm risking $150, right? And I control the stock at $80 per share, no matter how high it goes, between now and that third Friday in December. Okay, so I pay and take delivery of one of those options, right? Okay, if I decide to exercise the option, okay, the stock is now heading higher. The stock is at $84 per share, and we are approaching expiration Friday, okay? This says we are at expiration Friday. And I decide, you know what, I like that stock, okay? I have the right to buy it at $80 per share, okay? I paid $1.50 for that right. So if I exercise that option and I now own 100 shares trading at $84 per share, my cost of entry is $81.50. Do you see that? So it's the 80 strike price. I paid $1.50. Now, if I would have bought the stock at 79, hey, I'd be up $5, wouldn't I? But you know what? Number one, maybe I didn't have that much money. Okay, and number two, maybe I was concerned about, there was an earnings announcement or a product announcement. I didn't want to risk $7,900. Maybe it would be trading at $7,000, wouldn't it? Okay, so when I exercise that option, I have taken delivery of 100 shares of the underlying stock. Okay, now I have an unrealized gain of $250, right? The stock is trading at 84. My cost, and when we talk about cost on these things, we are not adding in any transaction costs you may pay to your broker. Okay, I am, on paper anyway, I'm up $250, right? So now my new risk, I have exercised this option. My new risk is not whatever I paid for this option. My new risk is owning 100 shares of the underlying stock. I am now risking the whole $84 or $81.50 that I am in it. Okay. Guess what? Most investors don't take delivery of the underlying stock. So this is where I thought the stock was going higher. It's trading at 79. I didn't want to put up $7,900. I think this is a $90 stock by the end of the year. All right. I was right on the direction, but I was a little bit off on the level at which the underlying stock went to. So it's now trading at 84. So I have a choice here, don't I? It's an option. I have the option of taking delivery of the stock. I also have the option of selling the option back into the open market. Okay, contact my broker, whether it's by phone or whether it's online. I'm going to sell to close the position, sell to close one of the December 20th 80 strike price calls. And if the stock is trading at 84, I would expect that at expiration, that option would be worth approximately $4, wouldn't it? Maybe a couple of pennies less, maybe a little bit more. All right. So what do I have then? Well, guess what? If I sell the option for, let's just say $4 to keep it as a nice round number, I have nothing, right? I bought the option for $1.50. I sold the option for $4. So at the end of the day, I have no stock position. I paid $150. I collected $400, and I made $250 before any transaction costs. This is what most investors do. If I'm wrong, maybe I sell the option and take a small loss. If I'm terribly wrong, I could lose the whole investment, but it's limited to what I paid. If I'm right, would I like to be a shareholder and get all of the rights and privileges therein, right? Vote annual meetings, collect the dividend, etc. Or, you know what, the stock did its job. I'm going to move on and maybe find another stock. Maybe I will buy a different option with this stock. Okay? But I will sell the option rather than exercise it because I have the right to do either one. Okay? I hope that makes sense. Let's talk about someone that sells an option. Okay? Well, that's pretty simple. Someone who sells an option collects money, don't they? All right? If I sell a call option, I collect money. and I have an obligation to deliver the stock anytime between now and expiration Friday at whatever the strike price is. If I sell a put option, I have an obligation to buy the underlying stock. Someone can put the stock to me, all right, and I must pay whatever the strike price is that I sold the option on. Now, in both cases, I collected money. So the good thing about buying options is I'm paying money, but my risk is limited to the premium that I pay, right? With selling options, the good thing is I'm collecting money. Someone is paying me, but I have an obligation to perform, okay? And if I get assigned, right, what will happen is I sold an option, and Ed at the OIC bought an option on this particular option, and on this particular stock, and he exercised his option, and I was assigned. Okay, I'm going to talk about that on the next slide, okay? I have an obligation, if it's a call option, I have an obligation to deliver the shares, okay? If I sell a put option, I have an obligation to send him cash through my broker, and now I am the owner of the underlying shares. So I would get an assignment notice from my broker that, hey, you were assigned, okay? Right, and for entering into this obligation to either sell the underlying shares if I sell a call or to buy the underlying shares if I sell a put, I'm collecting money, right? In this particular case, if it's an option premium of $3 and I sell that option, hey, I just collected $300. But you know what? As long as that option is out there, okay, I have an obligation to do something, right? Either deliver the stock if I sell a call or take delivery of the stock if I sell a put. When I sell an option, okay, in this case I sold an option for $3 times 100 shares, right, $300. That's the most I can make, okay? If that option expires worthless, and I have had options expire worthless being a buyer, I've had options expire worthless where I was a seller, but if I'm a seller, the most I can make is $300, right? If that stock goes the way I think it might, I'm only going to benefit by whatever I collected as the option premium, okay? So let's just talk about assignment here, okay? When I am assigned, right, we don't go too much into the assignment process, and I've had investors, individuals ask me before, well, Marty, you know, I sold this option at a certain price. Why would that particular person ever exercise me? That's not the way to look at it, okay? What happens is that when remember I told you could buy this option on any exchange, and later on you could close the position, right, and sell that option on any exchange, okay? When you sell an option, your name just goes into a big bucket over at the Options Clearing Corporation. I'm sure Edward doesn't like that terminology, but it's in a bucket, right? And anyone who owns this option that says, you know, I'd like to exercise this option for whatever reason, they could exercise it, and they kind of reach in and pull out a name, and maybe it's yours, right? But in this particular case, right, we're approaching expiration Friday, and I sold the 80 strike price call and collected $1.50, right, and the stock is up at $84. And if I do nothing, I would be assigned, okay? And what would happen there is that, yeah, I collected, the $1.50, but I have to deliver the underlying shares, don't I? Okay? So it says here the unrealized loss is $250. Now, maybe it is, maybe it isn't, okay? And the bottom line says that I have the risk of maybe being short the shares. That's not how I sell call options, okay? When I have one position on right now where I own the stock, I sold call options. In this case, you know, the stock is at 79 and I sold the 80 call. That option is the term, once again, I'm a page ahead of myself, is the term is out of the money, right? I'm anticipating the stock will go a little bit higher. And remember, this, with the stock at 79, when I sold the 80 strike price call for $1.50, I'm effectively saying I don't mind getting rid of the stock at $81.50. Okay, eliminating any transaction costs there. okay? And now that it's up at 84, I have the decision to make expiration week. Let's just assume that I have not been exercised on this, okay? I do expect to be exercised on expiration Friday. But if I say, I bought the stock at 79, I'm out at 81.50, I'm no longer as excited about this stock, or I'm not excited about the market or whatever, I'm happy to let this stock go, and I am obligated, remember, to deliver 100 shares of stock to someone. I don't care who it is. So I'm in at 79, I'm out at 81.50, I made $250, okay? Now the bottom line here says, well, if you don't own the underlying stock and you just randomly sell calls, in this case we could be short the stock at 81.50, it's at 84, isn't it? Okay? I don't like to sell call options on stocks I do not own. That would be called a naked sale. Okay? When I was a trader on the floor, I didn't like to have unlimited risk. I like to quantify my risk by using different strategies. But this was the strategy that I first started out with back before I was a floor trader, okay, with the covered call. And I said, we're going to cover that in another 15 minutes or so, all right? But in this particular case, let's go back to the assignment. If you are short an option, if you have sold an option, you do not control whether you are assigned or not. Okay, it is a random process through your broker to the Options Clearing Corporation, and you will be notified when you are assigned. Okay, so assignment is not bad. If you buy a stock and then you sell a stock higher, that's not a bad event, is it? Okay, but in this particular case, when we are assigned, we will be notified. The Options Clearing Corporation contacts your broker. They very quickly notify you that you were assigned on this particular stock, and we will deliver 100 shares of stock for you. Hopefully you own the underlying shares, and this is called the covered right. We are writing or selling the call option against the stock that we pretty much own. I think, Ed, I've kind of gone into your territory talking about how assignment works at the Options Clearing Corporation. Did I kind of explain that correctly and simply, or do you have a better way to use the wording on that?
Absolutely, you were correct on the way you outlined that. Exercise instructions are communicated to OCC by the clearing member firm who wants to exercise their position, and then OCC is aware of who on the other side has open, short, assignable positions and goes through a random assignment method. So you were absolutely spot on with that. And of course, clearly understanding rights, obligations, exercise, and assignments paramount. That's the ground floor, and you have to understand this before you can get into looking at further concepts. I just want to emphasize a few things that you went through, Marty, and looking through the questions and comments we're getting online. You were absolutely correct. The majority of options are closed out before ever reaching expiration. This leads to one of the myths that's widely circulated out there, which says that most options expire worthless. It really isn't true. The majority, data has actually shown about 70% of options are closed before they ever reach expiration. Now, if you isolate the remaining 30%, the vast majority of those do expire worthless. Well, that makes sense. If you own an option that doesn't have any value at all, you never had a chance to exit that position prior to expiration, and you're left holding it through. But that myth that's out there that says most options expire worthless, that really is a myth. It's not true, because most options are closed out. Also had a few questions about the premium that you walked through, Marty, and I think it's interesting, questions circulating around when is the premium collected when you sell an option. Well, it's collected immediately, but here's what's interesting. When you're watching your account as you're making these trades, if you sell an option, you will receive the funds right away and see an increase in your cash position in your account. However, if this is an option that you're writing, the short option position will go into your account as well as a debit, and your brokerage firm is likely going to have some methodology that they use to read what is the option worth or how much would you have to pay to buy it back, and that is the debited amount that they would use. In a perfect world, those two numbers are exactly the same. They probably won't be, but in a perfect world, they're the same. So the credit on the cash side minus the debit on the position side means your account itself should not change in value. As I said, in reality, it probably does change slightly, but those two forces of credit and debit really do counteract each other. That was a great explanation on exercise and assignment there, Marty, and rights and obligations. Let's shift. Let's push things a little bit further and get into the term of moneyness. It's one of the most widely circulated terms. It's very simple to understand, I would say, but really important when you're evaluating the price of an option and what's going to happen to it, understanding how it changes over time with the changing in stock price movement and time. So Marty, back to you, moneyness and theta. Can you walk us through what these things are all about?
I certainly can. I'm going to backtrack just a half a step as well. And when you're talking about options expire, I sold a few options, had to be about 2-3 weeks ago at about 40 cents. And it's not real important, call or put, or what the name of the stock is. That's not really material to our conversation. Last Wednesday, these options were expiring last Friday. Last Wednesday, I bought the options back for 2 cents. And they did expire or worthless on Friday. Okay, but the question that some people would ask me was, well, Marty, why would you pay 2 cents to buy those options back? Well, I have no ticket charge with my brokerage firm. You know, I was just paying 2 cents. Now, remember, that's per share, so it was $2. Okay, so $2 per contract. I bought these contracts back. I only sold a few of these things. And the reason was because, you know, here it is Wednesday morning. There are 3 trading days where there could be news on this stock that could, you know, adversely move the stock. And also Friday, I was driving 400 miles northwest to the Twin Cities to attend an event, and I would be in the car all day Friday. I could not really watch this position. So I thought, you know what, for me, I would just be much happier buying this option back. I sold it for 40 cents. I'm buying it for 2 cents. I no longer have an obligation for the next 3 trading days, or especially the final day when I'm dealing with the traffic on the interstate, and I just was more comfortable. So this is an example of why someone might have a position that's working for them, where they close a position. They don't have to. I didn't have to do anything, right? It's my right to do anything I wanted. I just didn't want to deal with the possibility of something crazy happening with the stock, and I'm tooling down the highway and not being able to really do anything with it. So I just wanted to bring that up as an example. And let's talk about then the slide that we have here, the moneyness of an option, right? So there are terms that we use with options. Okay, and when you take a look at let's just stick with the call options, right? In the money, at the money, and out of the money. Okay, and what I did was I sold an out of the money option. All right, and if we use the example we used a couple of slides ago with the stock at 79, you know, I might sell the 80 strike price call. That option is out of the money, right? The strike price is up above where the current stock price is. Easy for me to say. Okay, so it's intrinsically worthless, isn't it? Okay, but it is trading for something. If we were looking at an in-the-money option, if the stock is at 79 and I did something with the 75 strike price call option, that would be in the money by 4 points, wouldn't it? So that option would be worth at least 4 points plus whatever time premium that the market assigns to this. The 80 strike price call would be close to at the money. It's technically out of the money by a point, isn't it? Okay, but it's close to being an at the money option. And the at the money option is the stock price and the strike price are almost exactly the same. They don't have to be exactly the same. You could be a little off, right? $79.80 or $80.10 or $80.25. I'd call that 80 strike the at the money option. But if the stock is trading at 79 and I'm thinking of doing something, either buying or selling the 85 strike price call, hey, that's out of the money, isn't it, by 6 points. The stock price is lower than the strike price by 6 points. Now, put options, it's kind of the mirror image, but it's kind of an upside-down mirror image, if you're watching my hands, okay? The in-the-money option is where the stock price is below the strike price. So with the put, for example, if the stock is at 79 and I'm looking at perhaps buying the 85 strike price put, hey, you know what? That's the right to sell the stock at 85, the stock's at 89, that option is $6 in the money, isn't it? Okay. The 75 put would be the bottom one, the out of the money. So with the stock at 79, if I'd like to buy the 75 strike price put, it's the right to sell the stock at 75. Hey, that's out of the money by 4 points. That option is intrinsically worthless right now. It might not be worthless later on, right? But it's an out of the money option. The 80 put is in the money by about a point, but the stock's at 79, but I consider that to be close to an at-the-money option, slightly in the money option. So options are either in the money, at the money, or close to at the money, or out of the money. The calls, remember, the call strike price would be lower than the current stock price, and the put strike price would be higher than the current stock price. I think that kind of makes sense how we talk about in, at, and out of the money. Moneyness, when we talk about this, it doesn't mean profit. Okay, if I own the 75 strike price call and it's $4 in the money, that doesn't mean that I have $4 of profit, right? It depends on when I bought it and where I bought that particular option. Okay, right? What we're doing is we're using this to kind of determine what intrinsically is this particular option worth. Okay, stocks move higher and lower all the time, don't they? Okay, but when we're looking at like the at the money and out of the money options, right? The stock's at 79. If I'm looking at the 80 call or the 85 call, as the stock moves around, the prices of those options will change, but intrinsically at this point in time, they're worthless. Now, remember, maybe it's a December option. We might have, though seeing this on a tape delay, we might be in the middle of October here. We might have 2 months to go until December. So there's certainly, that option is worth something because there's a lot of time left. We've got 2 months left, right? But still, the idea here is that out of the money options and at the money options at expiration Friday will expire worthless. So if this stock is trading at 79 on expiration Friday, the 85 call is worthless, and the 80 call is worthless as well. Because if someone owned the 80 call and they say, well, I like the stock, I'd like to buy the stock, why would they exercise their option and pay $80 per share if they can go buy the stock at $79 per share? That doesn't make sense, does it? Okay? So in the money, at the money, out of the money are terms you will hear when people talk about certain options or certain option strategies. Okay? So what we're looking at here is strike selection. Which strike price do I want to buy? Okay? With a stock, we have, XYZ, there's one stock XYZ, isn't there? We can buy it or we can sell it, right? But when I take a look at options, you will see that there's a big difference in many choices as to which strike price to get involved with, right? So when we have the pricing components, we have the intrinsic value and time value, okay? Intrinsic value is, what is this option intrinsically worth? Is it in the money? Then it's intrinsically worth something, isn't it? But if it's trading for more than that amount, what we're looking at there is time premium or time value, okay? It's kind of made up. When we're looking at time value, this is the tough one to measure, isn't it? If the stock is at 79 and I'm looking at the 75 strike price call, that's an easy one. That's $4 of real or intrinsic value, right? But when I'm taking a look at the 80 call, maybe the 80 strike price call is trading for $2. Well, how do they come up with that? Well, it's pretty simple. They're taking a look at how much time do we have until expiration, right? How volatile is this stock? Now think about that. If we've got two stocks trading at $79 and one is a crazy internet stock, okay, and the other one is a very boring utility, you would expect that the utility most times, okay, I'm not making I am making generalizations here, but the utility stock should be kind of a boring stock. I don't expect a big move in this stock one way or the other, okay? But the crazy internet stock could be anywhere, couldn't it? So you could have two stocks trading at $79 and, stock A, the boring utility, the option might be trading for $1, the 80 strike price call, and the internet stock, the 80 call, could be trading for $5. Why? Because it's the implied volatility. How volatile is this underlying stock? You know, the OIC has a great education site, as does your broker, and as do most of the different exchanges as well, where they can help you with some of these educational tools. And you're here right now trying to learn a little bit, okay? But they can explain a little bit about the implied volatility. And you see the volatility move higher traditionally as we go into an earnings announcement, don't we? Okay? And as the earnings announcement is made, the stock's going to move where it's going to move to, but the implied volatility comes back down a little bit, okay? Because the news is out, isn't it? Now, maybe the stock will react over the next couple of days based on that news, but the main uncertainty is now behind us, right? And that's kind of measured in implied volatility. The other things that go into the pricing of this are there dividends, right? That may affect what this option is worth if the stock is moved down by the ex-dividend date, and also any interest rates. Now, interest rates are kind of low now, but I go back to the trading floor where the prime was, well, I can't tell you how high it was because you won't believe me, but it was over 20%. You know, that had a profound impact on options where people said, hey, I'd rather buy a call option than buy the stock, right? And maybe I can keep my money in the bank or at my brokerage firm and earn a great deal of money. So interest rates are certainly a component as well, okay? In the money options have intrinsic value and may have what we're saying here is extrinsic value or time premium, okay? Out of the money options and at the money options do not have intrinsic value. All they have is time premium. How much time is left? How volatile is this particular stock? And that will affect how the option is priced, okay? So the other thing we have to choose, in addition to many different strike prices, okay, on this particular stock, we have many different lengths of time. You know, years ago we used to have 3, 6, and 9 month options on stocks, and as that front one would come forward and the what was the 3 month option now expires, we would have, remember that the 9 and 6 month option are now the 3 and 6 month option. We would add a 9 month option. We added weekly options to many stocks. We have leaps, long-term options on maybe a quarter to a third of the different stocks, going out as far as about 30 months. So some strategies you might do in a very short time frame, like I did with my covered sale of an option a couple of weeks ago, and other people, you know, might have, well, I'm more concerned about, you know, a year or 2 years from now, I think XYZ is going to do, you know, something wonderful or something terrible. You could participate with a long-term option as well, okay? So, and they're all made up, by the way, of real or intrinsic value and extrinsic or time value, okay? And what we're saying here is, you know, we've got the 50 strike. It could be leaps. There could be weeklies. There could be monthlies, right? The thing you have to determine, if you own a stock, maybe you just put it away in a vault and sit on it for years and years and years, okay? But when we're looking at options, what we're looking at is, okay, what direction do I think the stock is going to, right, or ETF, and how long is it going to take to get there? You know, when will it get there? All right? And if I have a short-term opinion, I'm going to use a shorter-term option. If I have a longer-term opinion, maybe I'm going to do something on a longer basis. All right? Here is kind of your typical time decay, okay? And options are kind of funny. If a 1 month option is worth $1, a 2 month option shouldn't be worth $2, okay? But what happens is the option holds onto its premium. It holds onto the time premium until we get closer to expiration. So a 1 year option trading for $4, a month from now maybe it's trading for $3.90 or $3.95. All things being considered, I'm assuming the stock hasn't moved and interest rates haven't, you know, I'm making a lot of assumptions, right? And it's not a very volatile stock. It stays right there, okay? But as we get closer to expiration, the decay happens much more quickly. So the top line you see where it says at the money, that's the at the money option. The at the money option holds onto its time premium because, hey, a lot can happen. This stock could really make a move one way or the other, a couple of points away from the current price, which is near the strike price, the at-the-money strike price. So maybe this option could be very valuable very, very quickly, right? Or it could be worthless very quickly. The bottom line, the in-the-money option, this is more linear, okay, where an in-the-money option and a far, far out-of-the-money option seem to decay at the time premium seems to decay at a much more measured, similar pace. So the option that's trading for $4 that now is, the stock is trading at 84, maybe it was trading for $5 with a year to go, and almost monthly it seems to be losing about, 8 or 9 cents a month because it's in the money. But the at-the-money option holds onto the time premium much longer. The same with out-of-the-money options. They're kind of worthless. They're kind of low-priced, but maybe it was trading for 20 cents, and a month later it's trading for 18 cents, right, with a year to go. So when you see the time decay curve, what we are referring to most of the time is the at-the-money option seems to decay in this manner, okay? All right? See what we got here. We're going to talk strategies now that we've talked about, in the money, at the money, and out of the money, and different expirations. And you could take a look at a stock, at your broker's website, and you might see a stock. You've got 3, 4, 5, 600 different choices to make, don't you, as to which strike price, which month, which week, which year, if it's a leaps option, and that just might be the calls, and it also would be the offsetting puts. So lots of choices. So remember, one of the things we talked about is, where do I think the stock is going, and when do I think it's going to get there? And you don't have to be exactly right, but it's nice you just can't say, well, I like X, Y, Z. I'm going to do, well, let's get a little more specific as to what you think is going to happen. Ed, did I kind of cover that section correctly, do you think?
Absolutely, and those concepts are so important. The moneyness, as you said, the in-the-money option is sensitive to stock price movements. It has intrinsic value, and that's the part of the option value that does not decay. As the stock price moves, the in-the-money amount will change and maybe go from 0 to a positive amount, or change what its value is. But the point is, in-the-money options have intrinsic value, and the intrinsic part is sensitive to stock price movements. The other part of the premium, the out-of-the-money amount, or the extrinsic value, is sensitive to everything else, time passing, changes in implied vols, and other things. So I think that's a key takeaway to remember. Stock price movements will drive intrinsic value changes, and everything else involved in the market that's in a dynamic feature will affect the extrinsic value. A nice segue into our last segment here, Marty, the protective put, covered call options collar. This in the beginning, not necessarily trades that are recommended for beginners. They're just popular trades that are a nice way to take what Marty's gone through and then look at how you can apply these to positions. And of course, the ones we're looking at here will involve stock as well. So, Marty, just a quick risk-reward profile and a few comments across those 3 strategies to help our investors get started.
I sure will, Ed. Thank you very much. And these are 3 strategies, as Ed said. We're not recommending anything at all, but these are kind of popular strategies that you will hear other investors talk about or they might use. The first one we'll talk about is the protective put. And as I said early on, if you own a stock and it doesn't trade options and you're nervous about something, fill in your own blank, right? What can you do? Well, you can pray. That could work, okay, or you could sell a stock. But the other thing you can do is you can buy insurance. You can buy a protective put. Now, sometimes people don't like to use the term insurance, but I do, okay? I don't work for any exchange. Well, I'm representing the MIAX here, but I don't work for any brokerage firm or anybody else. And the idea of the protective put is this. Let's just go back to insurance. Just think to yourself. You don't need to send any answers in here. But how many of you own puts right now? And you know what? You all do, right? You have house insurance, health insurance. You have automobile insurance, right? You have all sorts of insurance, okay, where you are paying a premium, and I drive my car. I've got car insurance, and I have the right but not the obligation to turn my car into my insurance company down in Bloomington, Illinois, all right? But I still own the underlying product and I have insurance. Well, the idea here is, look, on the protective put, I own 100 shares of XYZ, and you know what? I'm nervous. Why am I nervous? They've got earnings coming out in 6 weeks, and maybe their CEO is going to have to go appear before Congress or something like that. I'd like to buy some insurance, at least temporarily. I'd like to keep my upside open. I think this is a great stock, okay? But temporarily, I'm nervous about something, and I'd like to buy insurance. Now, let's just say I buy a 90-day insurance policy. I buy a put going out to December or January. In 2 or 3 weeks, all of a sudden this market's doing well, the stock is doing well, there don't seem to be any problems. I can sell my insurance policy, right? I can sell my put back into the marketplace, and I still own the underlying stock. So when we take a look at, you always need to know, what's the risk reward here? Well, my potential reward is unlimited, right? I still own the stock. It can go to wherever it's going to go to. What's my risk? Well, the risk is whatever I paid for the insurance, okay, and where was the strike price? In this particular case, if the stock was at $79 and I bought the 80 strike price put, and let's just use a nice round number, I paid $2 for the put. I have the right to sell the stock at 80, but I paid $2. Well, my risk is, in this case, if this stock goes from 79 to 70, all right, the stock is down $9, right? I have the right to sell it at 80. I paid $2 for that right. Okay, it's now worth 8, right? I lost, what did I lose? Well, I own the stock, right? I lose $2 on the put, but remember, but $1 of it is intrinsic value, right? So I lose $1 on the way down. I own the stock, and I have insurance. If the stock were to head higher, now remember, I paid $2 for this 80 put. This stock has to get, remember, it's at 79 right now. This stock has to move up $2 to break me even. And you can see where that red line crosses the break-even line there, the stock price. But if the stock goes to 90 or 100, sure, I paid $2 for the insurance that I don't need, but you know what? I still own the underlying shares. So that's a protective put. The covered call is the strategy I first started with. I had a real job. I told you I worked for a real company. I was buying stock, and the stock was about $35 or $36, and I decided to sell the 40 strike price call. So what did I have? I had an obligation. I collected money, didn't I? Let's just call it $1, all right? But I sold the 40 strike price call. I had an obligation to deliver shares at $40 per share. I didn't do all of my stock, right? I didn't sell a call on all my stock because I thought, what happens if this company gets taken over, right? I'd like to participate. So I sold a few options against a few hundred shares of the stock that I owned. And if the stock went from 36 to 40, I own the stock, don't I? Now, above 40, I have an obligation to deliver those shares if I don't buy the options back. But that was, to me, saying it's the equivalent of selling the stock at 41. All right? Maybe I should diversify a little bit. The first few times I did this, the stock did not get to the strike price. And let's just say that it stayed right there at 36, and I was selling the 40. I'm collecting $100 per option contract. If I sold 4 contracts, I'm bringing in $400, right? Remember, we talked, why do people use options? Well, maybe as protection, maybe to generate income. I'm a retired old guy right now. I like to generate a little bit of income against my stock position. This is like a dividend. And if the stock gets called away, that's fine with me. And you know what? If this stock runs up close to 40 and I say, number one, maybe I don't want to pay taxes because I have a low cost basis, or I really do like the stock, I can buy the option back. Just like I did last week, buying back, an option I sold at about 40 cents and I bought it back for 2 cents. All right. So what's the reward? It's limited, right? Because I'm on the covered call. I don't only participate up to that strike price plus the premium I brought in. If volatility goes higher, there's news on the company or pending news or on a stock similar to it, you know what? That could work against me. Maybe that option price goes up a little bit, and I have sold that option, haven't I? Okay. Time erosion, time decay helps. The quicker we get to expiration, the better for my position. And my break-even point is wherever the stock price is, right? Minus whatever I brought in as the premium. So if the stock's at 36 and I brought in $1, my break even is 35, isn't it? Okay? And the last example I'm going to use is something called the collar, like the collar on your shirt. And this is where people have come to me and said, Marty, I own XYZ. I'd like to buy the protection. I'd like to buy insurance, but it's expensive. I don't want to I don't want to pay money for my insurance. Well, maybe you can combine, because you own the underlying shares, you could buy the underlying put insurance, the strike price, and finance it by selling an out-of-the-money call option. And look what happens to your profit and loss here. You have the risk of stock ownership for a few points higher or lower, but at some point your strike price on the put breaks you even on the downside, which is great. The adverse thing of this is you only participate with the stock up to the strike price on the call that you sold. Do you see that? So the good point is limited risk on the downside. The perhaps bad point is limited gain potential on the upside above the strike price I chose. Right? What's the reward? It's limited. Increase in volatility doesn't really affect you one way or the other because I own a protected put. I'm short a call. They both probably go up. And your break-even point, well, it should be pretty close to where you are right now, right? You will hear the term zero-cost collar. It doesn't have to be zero cost. Okay, you might have to pay a little bit for it depending on the strike prices and which expiration you choose. You might get a slight credit into your account, which is great, okay, if you bring in premium. But the idea with the collar is I can buy insurance and there's a cheaper way to do it. But there's an offset, right, that my potential gain is limited to the upside. So these are just 3 examples. There are lots of different examples. And this is, by the way, is an example of taking 2 very basic strategies, the covered call and buying the protective put, and combining them into something else, and this is called the collar. So you may hear people talk about trades. There's a commercial on TV right now where people are talking about a specific crazy trade. Well, I know exactly what they're talking about. They're just combining 2 very simple strategies and roll it all into one. Ed, we covered a lot of ground here, didn't we? Do you have anything else we should be covering or any questions that people have asked you?
It was really good, and you're right, a lot of ground covered. There was an interesting comment that I wanted to respond to. Someone had mentioned while you were walking through the strategies, they were looking at the protective put, and I'm going to go back there real quick, and they're saying, hey, doesn't that P&L graph looks a lot like the long call? And it's great when we get these kind of comments. I love when our attendees can notice this kind of stuff, and the answer is absolutely. Those are the same looking profit and loss graphs. There's a little more of a lengthy explanation to it, but this brings up the concept of synthetics and how you can use stock with options to create the same exact payout or risk profile as something else. And the long call and the protective put are exactly the same. Of course, the difference is probably the timing between these two. For the protective put, most often the investor already owns the stock and maybe it's moved higher in their favor and now they want to protect it by buying a put option. A call option, of course, would just be initiated outright. And while we're here, I'll just mention same thing on covered call. You might be looking at that P&L graph thinking this looks like selling a put option to me. It's true. It really is the same thing with the same difference. For covered calls, it's very likely that maybe you've already owned the stock and it's moved in your favor, and now you'd like to set a limit price on the upside to have it called away, generate some extra income. So you're executing the stock and the call separately. Selling the put would be one trade initiated up front to create this same exact looking risk profile. So that's foreshadowing a deeper concept, and we do get into a little more of that in our upcoming webinar series. Last thing, putting this back up on the board, please visit our website. We do have 3 more sessions today, so you can go to the events section of our website and sign up for those. If you can't stick around and watch them live, you can get emailed the recorded version. Please take the survey at the end of the presentation before you sign out. We watch the responses very closely, and we'll take into consideration all of your feedback. Send the Investor Services team questions at options@theocc.com. Our YouTube channel has many of these presentations that we've done over the years on there as well. So thank you all for attending today. Once again, thank you very much, Marty, for sharing your knowledge, and we hope to see you all at the next sessions. Thanks again. We'll see you soon.